Welcome to the Lowenstein-Sandler podcast series. Before we begin, please take a moment to subscribe to our podcast series at lowenstein.com/podcasts or find us on Amazon Music, Apple Podcasts, Audible, iHeartRadio, Spotify, SoundCloud, or YouTube. Now let's take a listen.
All hail the one big, beautiful bill. President Trump's signature legislation was signed into law on July 4th, 2025. What a coincidence. And most, if not all of it, takes effect on January 1, 2026. So it's high time we talk about what OB3, that's what the cool kids call it, or the tax geeks, depending upon your point of view. It's high time we talk about what OB3 does and how you plan for it. And as we'll see, surprise, surprise, there are some things in OB3 that aren't quite as beautiful as the name might suggest. From the law firm Lowenstein-Sandler, this is Splitting Heirs. I'm Warren Racusin. And do we ever have a couple of cool kids to take us through it? My colleagues Beth Kaufman and Kristin Taylor. Beth is the national chair of Lowenstein's Private Client Services Group. In a former life, she was the Associate Tax Legislative Counsel in the United States Department of Treasury. And most importantly, she is a Splitting Heirs veteran. Kristin, our Splitting Heirs Rookie of the Year, is a partner in our tax group and works closely with our T&E folks at the intersection where savings and estate planning meet. Beth, Kristin, welcome.
Thanks, Warren.
First, let's talk a little bit about the fact that OB3 makes permanent changes in the tax law. Beth and Kristin, how permanent is permanent?
I'd have to say, as with most things tax, it depends. As we'll see when we get into it a little bit later, some of the beautiful benefits put forth by OB3 are intended to sunset. Coincidentally, just as the current administration will be also sunsetting, while others purport to be permanent, but permanency is always dependent on the whims of Congress.
Whenever I say permanent, I put air quotes around it because permanent is only permanent until Congress decides that it isn't.
So there are things that are permanent in air quotes. There are things that are not so permanent, and they'll find out as time goes by, but they're permanent for now at least. So let's dive in a little bit. Beth, let's start with you and estate taxes, that 40% bite that Uncle Sam can take from your estate when you pass away. There is a big exemption to that estate tax, a get-out-of-jail-free card. But we've all been very concerned that big estate tax exemption carriage was going to turn back into a smaller exemption pumpkin on December 31st. But it didn't turn out that way, did it?
No pumpkins, Warren. Instead, what we've got is, watch for the air quotes here, permanent higher exemptions from estate, gift, and generation skipping tax. So now for 2026, we've got a $15 million per person exemption. So if we're talking about a married couple, $15 million for the one spouse and $15 million for the other spouse. What that means is that something like 99.8% of decedents will not be subject to estate tax. So when we're doing planning for people, we need to refocus and not think so much about estate tax for a good lot of people, but focus more on the income tax aspects, which might mean that a person holding on to their assets and getting a step up in basis at death is a better outcome for the family than gifting appreciated assets would be.
So in other words, in former times, we talked with clients a lot and still do with some of them about getting assets out of their estate during their lifetime to try to avoid bigger estate or gift tax or generation skipping hit on those. But now with the exemption being so high, and as you said, when you die, the basis of your assets for income tax purposes gets stepped up to date of death value. Maybe that planning gets flipped on its head. Give us a quick example. I bought Microsoft stock at $2 a share, and now it's worth $100 a share. What happens if I give it away during my lifetime, or what happens if I keep it until I pass away?
Right. So if you give that share of stock to your daughter, then she'll have your basis, your $2 basis in that stock. And if she wants to sell it, she would have a capital gain of $98 and pay capital gains tax on that. But if instead you hold that share of stock until you die and then bequeath it to your daughter, she would take it with its value of on your date of death as its basis. And so she'd get $100 basis. And then if she turned around to sell it, she wouldn't owe any capital gains tax at all. Now, that may or may not be a good trade-off if you are an estate tax paying decedent. But if you're out of the estate tax world because you and your spouse have assets of under $30 million, then it's going to be more of a tax win to hold on to that and leave it to her at death than it would be to give it to her while you're living.
What are a couple of other ideas that clients should be thinking about and people should be thinking about in light of this permanent increase in the estate tax exemption, Beth?
So another thing I think we should be concerned with for people who are now in that category where they're not going to pay any estate tax is to look at old estate planning and see if it's still relevant. So I think a good example of that would be a client where one spouse has died and set up a trust to keep assets out of the surviving spouse's estate. And now when we look at the surviving spouse's estate, she is well under the estate tax limits. So in that case, it might be better to devise a way to take those trust assets and get them back into her estate so that those assets would get a step up in basis when she dies, since there wouldn't be any additional estate tax triggered by doing that.
So again, planning in many ways flipped on its head from the way we used to think about things. Things are very different now with this large exemption and all but 0.2% of the population free of estate tax.
Exactly. But we need to remember, we also have many clients, most of our clients, who are still above that threshold for taxation. And for them, the planning techniques are all the same as they have been all along.
Right. And even for the 99.8% who are now freed from federal estate tax, there may be state estate taxes that they have to think about, right?
Indeed, believe it or not, there are still 12 or 13 jurisdictions that have an estate tax or an inheritance tax. And that can really impact the planning that you do for someone because some of those states are following along with these federal increases, but quite a number of them are not. So people residing in those states still need to pay attention to the lower cutoffs for estate taxes.
New York being a prime example, the exemption from estate tax in New York is only about $7 million. So it's a very different universe to think about when you're thinking about New York estate taxes if you happen to be a New Yorker and haven't absconded for Florida or someplace else like that that doesn't have estate tax. And finally, portability, our old friend, is still important, right, Beth?
Portability is still important. And in fact, I feel in some ways even more important because right now we have these really high estate tax exemption. And if someone dies while the exemption is as high as it is now, and they haven't used their exemption and they can make a portability election, they give that amount of exemption to their surviving spouse. Now, just like when we were talking about permanence, since we don't really know what permanent is, if you make that portability election, you lock in that amount of exemption that you're giving to your surviving spouse. So it's kind of like an insurance policy against the exemption going down. And people should really think hard before they skip over that opportunity to save that exemption for the surviving spouse.
So as an example, if somebody dies this year when the exemption is $15 million, they should port or transfer their unused estate tax exemption to their spouse, because if their spouse dies in a year when the exemption is only $5 million, I'm making this up, the surviving spouse will still have $20 million of exemption, the $5 million they have on their own ball, plus the $15 million that was transferred to them by their deceased spouse during lifetime, right?
Right. And let's say that surviving spouse has an estate of $10 million. They're going to save a lot of estate tax by having made that portability election if the exemption does go down at some time in the future.
Right. So estate taxes are obviously exciting to Beth and me, but there's a whole other side of OB3, which is the income tax side that probably interests people as well. And there are a bunch of facets to that, Kristin. Let's talk about some of those. First, let's knock out the real basic ones. Top tax rate?
Stays at 37%.
Instead of going up. Standard deduction?
That has been increased by $750 per taxpayer to $15,750 for a single filer and $31,500 for married folks filing jointly. This amount is also now indexed for inflation.
So the good news about that is that the exemption from income tax is higher. The thing to keep in mind is that if you have itemized deductions, unless they are more than $31,750, you're going to lose the benefit of that. And so you need to plan for that.
Exactly right.
No tax on tips, right?
Yeah.
Kind of.
Starting in 2025, certain tipped workers can qualify for an above-the-line deduction. So this is a deduction for non-itemizers, which can potentially lower taxable income by up to $25,000 per return. One thing to note here is that if you're married, you can still only deduct up to $25,000 per joint return, and you're disqualified from claiming this deduction if you file separately. So if you have two tipped workers, you're still subject to that $25,000 limit, even if you file jointly. The devil is in the details, as with all things. First, the tips have to be reported to your employer and the IRS, and they're still subject to Social Security and Medicare payroll taxes, as well as any applicable state and local income taxes. Second, the allowable deduction starts to shrink by $100 for every $1,000 of your modified adjusted gross income over $150,000 for single filers or $300,000 for joint filers. Third, not every job that receives tips will be eligible. The Treasury Department has published a proposed list of occupations that customarily and regularly receive tips. And once that list is finalized, if your job isn't on the list, your tips will not qualify. In addition, certain job categories are just completely excluded. So professional service businesses, your accountants, your architects, your consultants are not eligible, even if they do occasionally receive tips. There's a category for illegal activity, which gets a little interesting when you think about businesses that are legal under state law, but not federal, such as marijuana-related businesses. Lastly, there's a category for prostitution and pornography, which has not been defined, but depending on how it is ultimately drafted, may include certain online accounts through platforms like OnlyFans, through which a number of people currently receive tips.
Are those terms actually in the statute?
Yes. They've thought of everything.
Interesting drafting.
Yeah. And then finally, this deduction is scheduled to sunset after 2028, unless Congress acts before then to extend the rule.
And you said professional services are excluded. So the idea that I had at 3 a.m. of recharacterizing all of our bills as tips for ideas we gave out at a cocktail party is not going to cut it, right?
No, this provision does no favors for the legal profession.
Right. How about that? Why should this be any different, right? Now, Beth, this I know is one of your favorites. I know you're wound up and ready to go. No tax on Social Security benefits, right?
Sure. And this one's not even permanent. What gets me going on this is that it's for marketing purposes. It's no tax on Social Security. But if you actually look at the statute, it doesn't say anything about Social Security. What it really is an additional personal deduction for individuals who are age 65 or over and meet certain income limitations. If you're over 65, you don't even have to be on Social Security. You could be deferring your Social Security until you're 70, but you would still qualify for this additional deduction. The deduction is $6,000 per qualifying individual. So unlike the one Kristin was just talking about, if you file married filing jointly here and both you and your spouse are over 65, you can have 2 of these. Now, for the income limitations, this benefit is phased out for single people with modified adjusted gross income between $75,000 and $175,000. And if you're married filing jointly, that phase out occurs between $150,000 and $250,000 of modified adjusted gross income. So what this effectively does, if you think of it as offsetting some of the tax on Social Security, prior to this law, about 64% of people did not pay any income tax on their Social Security. And after this, it's going to be more in the 80% range. This provision is temporary. It took effect in 2025 and it runs through 2028 and would take an act of Congress to extend this benefit past 2028.
Clearly designed to benefit lower income workers, lower income seniors, et cetera, et cetera. That obviously is the policy goal. How it gets you there and whether that policy is appropriate, obviously, is another issue. But clearly, that's what they all had in mind when they enacted these rules. Let's talk about some of the little bit juicier stuff now. The world-famous SALT deduction. Kristin, first, remind everybody what SALT stands for.
SALT stands for state and local tax. And just to give us a little bit of refresher as to what we're talking about, pursuant to tax law changes under the prior Trump administration, a limitation was imposed on the ability to deduct state and local taxes.
Before the limitation, you could take an unlimited deduction for your state and local income taxes, property taxes against your federal returns.
That's exactly right.
Kind of a form of revenue sharing between the federal and the state government. The feds took a little less so the states could get a little more, right?
That's exactly right. And then in 2017, as part of the Tax Cuts and Jobs Act, or TCJA, that deduction was limited to $10,000. And this was obviously primarily impactful to and intended really to target high tax states, including New York, New Jersey, and California, and has been a political hot button issue since.
So the cap is now increased to, you can take up to $40,000 of state taxes against your federal income tax, but there are some limitations to that also, right?
That's right. It's subject to a phase down, which kicks in for taxpayers with modified adjusted gross income over $500,000, which ultimately at a full phase out reduces the deductible amount to $10,000. Both the limitation and that modified adjusted gross income threshold are increased by 1% each year through 2029. Following which this increased limitation is scheduled to revert back to the original $10,000.
Right. So again, to overstress the metaphor, the $40,000 carriage turns back into a $10,000 pumpkin at that time.
That is correct. Another bit of good news for those of us in high tax paying states is that what has not changed is the ability for certain taxpayers who conduct business through partnerships or S corporations, so flow through entities, to take advantage of pass-through entity tax or PTET deductions that are available in certain states, including New York, New Jersey, and California, which were implemented as a workaround to the federal SALT deduction limitation. So that strategy still remains available.
Those were spared in this legislation.
Correct.
Right. That's SALT. Let's talk about QSBS. We in Taxland, we love acronyms, although I haven't come up with a good acronym for QSBS. SALT, it's like QuizBis. It doesn't really cut it. But anyway, what is it?
Yeah.
So tell us what it is.
QSBS, also known as Qualified Small Business Stock or 1202 stock, after the code section which provides for this tax benefit, is generally stock of a U.S. corporation that satisfies certain requirements. And the exciting thing is that a taxpayer who sells QSBS can potentially exclude from their taxable income all or a portion of that gain. Under prior law, a taxpayer who sold QSBS after holding it for at least 5 years could exclude the greater of $10 million or 10 times their basis in the QSBS, which is usually the amount they originally paid for the stock. Under the new rules, taxpayers can start to benefit from a partial gain exclusion earlier. There is a 50% exclusion rate for stock held at least 3 years, 75% for stock held at least 4 years, and a full exclusion kicks in at 5 years. In addition, the cap has increased to the greater of $15 million, which will be adjusted for inflation starting in 2027, or 10 times their basis. And then lastly, one of the requirements for qualified small business stock status, namely that the issuing corporation have aggregate gross assets below a certain threshold, has been made more favorable, with the limit increasing from $50 million to $75 million, which will have the effect of allowing more businesses to potentially issue stock qualifying for this exclusion.
So the original QSBS rules and this extension obviously were designed to promote entrepreneurship. At least that was the stated purpose. By giving people a break, they create a successful company and then sell it, give them a break on their taxes to reward them for the fact that they hired people, they created something, they innovated, etc.
That's exactly right. And also to encourage investors to make investments in small businesses in the United States.
But the one thing, and I mentioned earlier that Kristin sits at the intersection of tax planning and estate planning. One of the things that is right at that intersection is something that Beth and I and the other folks in the group do with respect to QSBS that survived OB3 and is still very much part of the law. And that's what we sometimes call stacking and packing.
Sure. So for stacking, in general, you can transfer qualified small business stock by gift while preserving QSBS benefits for your beneficiary. And in addition, and this is what makes this an exciting strategy, not only does that beneficiary potentially get access to the gain exclusion, each beneficiary is subject to their own $15 million cap. So you can essentially multiply the amount of potentially excluded gain by gifting it among family members or using trusts.
So if I created the next Microsoft and I have $45 million worth of this stock and I have 3 children, I can get my own QSBS exemption, plus I can give $15 million worth of stock to my 3 children. Actually, that's more, that gets to $60 million. So by using that strategy, you can eliminate the tax on most, if not all, of the capital gain. Plus, you've gotten that value out of your estate for estate tax purposes, and all of its future growth won't be hit by the 40% estate tax.
It's a win-win.
It's a win-win. It's a win-win-win. And again, we were pleasantly surprised that they didn't go after it because it has certainly gotten attention, right, Beth? But it survived, right?
It has. One thing to point out is you want to make those gifts early on, because if you wait until it's worth 15 million, 3 times 15 million, you're going to have a little hefty gift tax bill there.
That is correct.
So we like to see these people early in their planning to do this kind of setup for them.
Finally, let's talk about charitable planning, something that's near and dear to a lot of people's hearts, especially we're recording this in December, but certainly towards the end of the year when people are thinking about year-end charitable gifts. There is some good news and some not so good news in OB3 about charitable planning. Kristin, since you're the rookie, you want to take the good news, and then we'll give Beth, the veteran, the bad news side of it.
Absolutely. So in good news, beginning in 2026, an above-the-line deduction is added for charitable contributions that are made by taxpayers who do not claim itemized deductions. And this is limited to $1,000 for single filers and $2,000 for joint filers. One thing to note here is that this deduction is available only for cash gifts that are made for public charities and is not available for donations to donor-advised funds or certain supporting organizations. For taxpayers who do itemize their deductions, the good news there is that there have been some technical corrections that were made to language that was originally added to the code as part of the TCJA in 2017, such that it is now clear that cash contributions to public charities are deductible up to a limit of 60% of a taxpayer's adjusted gross income.
And by above the line deductions, you mean it comes right off the top of your income. It's not subject to any kind of limitations that might otherwise be in the tax law. It just comes right off the top.
That's correct. Similar to the standard deduction.
Right. Similar to the standard deduction. So Beth, turning to the not so good part, and I have to say, this is the part of the podcast that I have been waiting for, where you explain the 237th rule, which I really can't wait to hear about. So have at it, please.
All right. So there are actually 2 ways in which OB3 carves back itemized deductions here. One, and again, these are the terms that we cool kids are using. We call the first one the shave. So the shave applies to charitable contributions. And the way it works is that you compute 0.5% of your adjusted gross income. So let's say your adjusted gross income is $1 million. 0.5% of that would be $5,000. Therefore, the first $5,000 of your charitable contributions are simply not deductible. That's the shave. The other piece of this we're calling the haircut. And under the haircut, the benefit of your itemized deductions is limited to the tax benefit it would have if you were in the 35% tax bracket instead of the 37% tax bracket. So what that means is that when you make your list of itemized deductions, let's say, let me make the math easy for myself. They total up to $1,000, but somehow they're deductible. Okay. So of $1,000, your tax benefit against a 37% rate would be $370, but we're only going to let you have the benefit as if your tax rate was 35%. So that would be $350. Doesn't sound like much when I use those small numbers, but it can add up. So what happens here, there are a couple of glitches in applying that 2/37 haircut. One is that there are people whose income exceeds the threshold for the 37% rate, but who don't actually pay tax at the 37% rate because of the types of income that they have. So let's imagine somebody who's retired and all of their income is coming from qualified dividends and capital gains, which are taxed at a 20% rate. There's no carve out from this for them. So even though the purpose of this haircut was to limit people to the same deduction they'd get if they were in the 35% rate, people who are in fact paying tax at 20% are subject to the same 2/37 haircut. It seems inconsistent with the policy behind this new legislation, but there is nothing in this law that lets those people be excluded from the haircut.
And whether that was just an effort to get the math to work and the budget economics to work, or whether it was just a mistake, I'm not sure that we know, or maybe we do know.
I don't think we really know. The other question people have been asking is, well, might we get a technical correction to fix it? Of course, that's always a possibility. Do I think that's probable? Probably not. We might guess. The rumblings we've heard here in Washington, D.C. are that there isn't much interest in doing any technical corrections for OB3 because it's so perfect and big and beautiful. So we're not holding our breath for a technical correction on that. But there's another issue here too, Warren, and that is we've had a haircut on itemized deductions before. For those who've been in the tax world for a while, it was something that everybody called P's, which had nothing to do with the green things in a pod and everything to do with someone in Congress who was Mr. Pease. Okay, so
with an E at the end.
P-E-A-S-E, Pease. Yes. So when we had P's, there was a specific provision in the code that said, this doesn't apply to trusts and estates. Yay, we got that get out of jail free card for trusts and estates. In OB3, they expressly repealed that exception for trusts and estates. So therefore, we conclude, okay, this haircut does apply to trusts and estates. And then when you look at how they define itemized deductions, it's basically everything that you deduct. Now, if you think about that in the context of trusts and estates, one of the big deductions that trusts and estates have is the distribution deduction. And the purpose of the distribution deduction is to avoid double taxation. So in other words, if a trust or an estate has income, if it holds that income and doesn't distribute it, then the trust or estate pays the income tax on it. If it instead distributes the income to a beneficiary, then the trust or estate gets a deduction for that amount, and the beneficiary includes it in their income. So it's kind of a closed system. Either the trust or estate is paying the tax, or the individual is paying the tax. But that distribution deduction now appears that it's going to be subject to the haircut. And that means we're going to have some degree of double taxation on trust income if it's distributed, because the deduction that the trust gets is not going to be as large as the income that the beneficiary is going to have to include.
So for everybody listening, we're going to be distributing a test shortly after this for you to answer the questions about how the 237th rule works in the context of no, well, I'm just kidding. But it is, I think that's an example of, number one, Congress trying to do so much that some stuff gets lost in the details, or maybe not. We don't know. But it seems like some things get lost in the details. Even more importantly, from our perspective, it goes to the fact that this stuff isn't as simple as it seems on the surface. And if you're at any level of wealth, any level of income, if you're starting to think about how to plan for the one big beautiful bill, you need to get some advice to make sure that you navigate through these twists and turns. And it's great for me to have folks like Kristin and Beth to help me navigate through it with clients. And we've just scratched the surfaces, which is all we can do in a podcast like this. But I think hopefully we've sensitized people to a little bit of the advantages, the opportunities, and some things you need to think about. Beth Kaufman, Kristin Taylor, thanks so much for your insights today. Thanks for everybody. Good to be social, and Chris Johnson and all our team here at Lowenstein for helping to put these together. We will see you next time. Till then, as we say in these parts, have a good one.
Thank you for listening to today's episode. Please subscribe to our podcast series at lowenstein.com/podcasts or find us on Amazon Music, Apple Podcasts, Audible, iHeartRadio, Spotify, SoundCloud, or YouTube. Lowenstein Sandler podcast series is presented by Lowenstein Sandler and cannot be copied or rebroadcast without consent. The information provided is intended for a general audience and is not legal advice or a substitute for the advice of counsel. Prior results do not guarantee a similar outcome. Content reflects the personal views and opinions of the participants. No attorney-client relationship is being created by this podcast, and all rights are reserved.